looking for your answer. So taking off from the subject that we have, which is about technology and retail lending, maybe it might be a good thing for you to explain to some of us what exactly is iSpirit and Credal all about and what they do, and then maybe we will expand it to what it impacts the larger ecosystem of retail lending. So by way of an introduction, can you give us a little about the two organizations that you are involved with?
Sure. Okay, so let me start with iSpirit. So iSpirit is the Indian Software Product Roundtable. So it's basically a bunch of software professionals that actually came together to help build digital public goods in India. And, it's a no greed, no glory volunteering organization. So basically, people who, they volunteer, they don't get paid, and they just actually contribute to building digital goods. And the digital goods that you would be aware of will be Aadhaar, eSign, UPI. I'm sure a lot of people use Google Pay, Phone Pay, Bharat Pay. So UPI is built on that digital infra. And more recently, it's called Account Aggregator, which is India's version of of open banking, which is the ability to share bank statements and other financial data about yourself when you want to apply for a loan. So that launched in September last year. And then finally, the fourth piece that ties all this together for instant credit is the Open Credit Enablement Network, which we are now building as we speak. And that basically helps provide sachet loans in an economically viable fashion for a lender. And this will be housed in a non-profit called the Cred Alliance Foundation, or Credol for short. So think NPCI to UPI, think Sahamati to the account aggregator framework. Credol will be the same thing to the Open Credit Enablement.
Got it. So are we moving from a time when you could bank anytime, transition from an anytime banking to anywhere and everywhere banking, because all you need is a phone, and there's this famous cliche line that goes around that you need banking, but you might not need banks in the future.
No, that's exactly right. See, the problem when you have establishment costs, when you have people, that means, you can only cater to a certain level of customer, right? So more affluent customers, and we often hear about building for the billion, but it's not possible to cater to sachet loans for sachet financial products. You can't, someone's taking a loan of 3,000 rupees, you can't really visit them because the cost of the visit only will be that much, right? I think that is the way to go. So currently people are building for the 70 million to 100 million affluent customers in India. What we are attempting to do is provide the infra that can serve financial products to the bottom of the pyramid, where currently it's not viable. So for example, if you just take UPI, if you're giving someone a 500 rupee loan, an intraday loan and you send it via traditional methods, you'll pay 1% each way. And that itself will amount to almost 700% in terms of interest. So what will the lender make, right, for a 9-hour, 10-hour loan? So UPI with no merchant discount rate makes it free. So then giving credit, in a completely automated fashion via UPI to an end user actually becomes viable. So that is the basic fundamental that this is built on. And the other thing we also look at is we don't look at, 1 year, 3 year, 5 year horizon. We actually think in 15, 20 years. Because we often get asked the question that, how will this villager in India use all these services? But we are not building these assuming that they have a smartphone and the internet today. We are building assuming that they will get it tomorrow with cheaper phones, with internet penetration. And we want to make sure that the infrastructure is robust when they do end up having smartphones in their hand.
So actually that takes away my next question, because increasingly with the penetration into the tier 2, tier 3, tier 4 cities, as you rightly said, smartphone, internet connection and all that is going to be a challenge. But what you seem to be saying now is that we will focus on those who have access now, and over the next 5, 10, 15, 20 years, we will hopefully have the infrastructure, both technologically, to enable a larger population of this country have access to this facility.
Well, actually, it's not that you're focusing only on the people who have now, right? If you don't lay this infrastructure, you can't start building it when they get access to the internet on the smartphone. You got to build it assuming the trajectory will be there, that they will adopt technology, and then you'll be able to provide services at the same time. So obviously you can't time it exactly, but the idea, and it takes a significant amount of time to build the initial versions of this infrastructure where you're testing it, making sure it works, you get the marketplace to adopt it. So we hope like in 3 years, you'll see an explosion of credit to the underserved.
And what do you feel in that context in terms of data security and confidentiality and all that? Because this concern, and every day in the papers you read about somebody getting hacked and his information getting hacked and money getting hacked and being duped. So how do you expect or propose or suggest that that should be something that people should not be concerned about going forward?
Right. So, look, whilst we're enabling the sharing of data, it is consent based. So, there's a new class of entity called the account aggregator. So, they're actually separate apps, and you can actually go to the Play Store and download these apps even today and use them. So, there's one called FinView Money, another one called One Money. I think CAMS and a few others. So if you go to the Sahamati website, you know which ones are live. You can actually go there. You have most major banks on there right now. You can sign up, create a consent handle, just like you do at UPI. Like you have a handle. Mine, like it could be like Rushikesh at city.com or whatever, or at City. So similarly, you can create your own, and you can actually link your bank statements and then consent to share. So it's still in the early stages. So we put the power in the user's hand. This is also, not to say that there's a lot of education that will be required, because it's not like this is an old concept that people understand. They will have to be educated how to use it. And there's also the ability to revoke consent if you choose. So it's the first time. I mean, I know all of you all have probably gone and clicked on some website when you're looking for a quote of a loan or insurance or what have you. And then you get bombarded with phone calls and that sort of thing, because you can't revoke any consents that you have given. This allows you to do that. And there's like a framework that has been put in place. The second thing, which is a longer tail thing that we're developing, is something called confidential computing. I think that will go too deep if we talk about that today. But it's basically, we are cognizant that if you are able to drive the sharing at scale of data, then you should also have a way to protect it. And you should have, they're called confidential clean rooms, and we're developing that as we speak, which basically what it'll do is it'll put data in a black box where the person who's got consent to receive it can't see it till you become their customer. So that is going to take another year or so to deploy. But see, a lot of this stuff happens very slowly, right? So whilst we lay out the infra, we're also building that, and we will test that before this scales.
All right. So, if you remember 20 years ago, and we both worked in the credit bureau industry, the credit bureaus and, machine learning and artificial intelligence and all that stuff came in. And that was seen to be the first version of technology revolutionizing the way lending happens. We now seem to be on the cusp of the second round with account aggregators and blockchain and, of course, what you are doing. Would you call this version 2 of the technological impact on retail lending, and what will it have to the common man? What is it that you and I as common man be affected by, and what should we be confident about? What should we be careful about as a user of all this new stuff that's coming in?
So let me just reset that, right? So see, the credit bureau, the when they came about in 2004-5, that was actually the birth of personal, retail lending to salaried people. And to be honest, I think Bajaj Finance did the best job of going down and capturing a very large part of that market. What we are doing today with account aggregator, OCAN, with UPI, this actually, we keep saying retail lending, but the largest underserved segment. So corporations get money because, bankers serve them because they're large amounts. Salaried people, in the last 20 years or 15 years since the bureaus have been around, they figured out how to lend to them. It may not be instant, but the lending still happens, right? Like pre-COVID, we had like the highest number of loans given ever in the history of India and that sort of thing. But the small business owner, like the sole proprietors, who form almost 89% or 90% of the businessmen. And there's this misnomer that, when you say MSMEs, that you're talking about partnerships and private limited companies and so on. But the largest part is sole proprietors, and they don't get business loans, even bite-sized ones. So this whole infra is being put in place to serve those people, right? So we've got a reference implementation in the government e-marketplace. It's called Gem Sahay, where we are actually able to give sole proprietors who receive a PO from the government e-marketplace a loan in less than 10 minutes, like money in the account. And that's the idea, right? The borrower interacts with the app at the lender's end. No manual work is required, including for the disbursal of the loan or KYC, right? So I think just to reframe that, we are now in the what credit bureaus did for retail lending, we are building infra now to create an explosion in MSME lending.
Got it. But having said that, you're building the infrastructure, and I completely agree that that's required. The question I have is that how are you going to how does one address the risk appetite of the lending people institutions to be able to go to what is perceived to be the riskier segment of society or borrowers?
See, this is not unlike what the credit bureaus did, right? So there was a learning curve. There, the credit bureaus helped the lenders, because obviously they wanted to sell data as well. So that you help them use that to be able to underwrite. So we do that. Like there are lenders who are reluctant. So we say start small, start conservative, give small loans so that the cost of the mistake is small, but start and experiment with what the credit policy that this segment hasn't been discovered, right? So what most lenders are doing, and they're already 6 live on Gem Sahay, 9 in the pipeline. We've got 14 interested in the next reference implementation, which is invoice financing that we're building with SIDBI, which is called GST Sahay. So there's interest, and you're talking about all the marquee banks, including our largest public sector bank, NBFCs. They're all willing to participate because, 2017 IFC study put the unaddressed MSME lending opportunity at close to $400 billion. So it's almost as large as the entire retail lending opportunity. So while often people say that, yeah, risky, but then, you never know till you do it, right? And there will be some initial cost to pay, but if you give small ticket loans, that cost is small.
Got it. Okay, so let's talk a little about account aggregators, right? There are about half a dozen of them out there who are, and we keep reading every day. Today morning, I read about one of the banks going live on its account aggregator platform.
I think it was PNB.
Correct. Now the point is that it's like if there are 7 account aggregators and the banks have gone live on their platform. Is it a competitive thing? Having 7 of them, is it a question of pricing? Is it a question of servicing? How does it work actually? Sorry, go on.
All public goods that we build are completely interoperable, right? So a better example before we come to account aggregator is UPI, because everyone uses a UPI, so it's easier to understand. Now imagine you have a bank account with, say, HDFC Bank, and you have a bank account with Axis Bank. Now you could link Google Pay to
Rishi, are you there? I think we lost you for a bit. Unmute him.
Yeah, I'm there now.
Yeah, we lost you. So I think you were starting to give us the example of UPIs.
Yeah. So just like with UPI, say you use Google Pay, link your HDFC bank account with Google Pay, and then enter someone's phone number, enter your debit card pin, and the money goes, right? Now, with account aggregator, the principle is similar. You go sign up with an account aggregator, you link your bank account. Now, only the difference this time data goes when you provide consent, not money, right? So it's built on the same overall architecture where the account aggregators and the payment services, like the payment apps, are actually consent managers. And in UPI, the money flows from one bank to another. In account aggregator, data flows. So, for example, if you wanted to go to, say, SBI and apply for a loan, you could just link your HDFC bank account, say, I want to share 12 months of bank statement data, click a button and it goes for automatic underwriting, right? Because it's machine readable, you can do everything automated. So that is the overall principle. It's very simple. Like, look, people took some time to get used to UPI, and then when we had private market implementations, the payment apps explained to everyone how to use it. So a similar journey will be followed with the account aggregators. They are live now, and we are going to plug them in to various use cases where you want credit. Like, so for example, Gem Sahay is one. Then imagine GST. You can share your GST invoices and then have share your bank statements and have lenders give you offers against each invoice, right? However large or small it is. So that is the idea. You no longer will have to share physical copies, have them stamped by the bank. This anyway goes directly from the bank and digitally signed.
Got it. But the slight difference I have is that in the case of UPIs, I want to pay you the money. It's a one-way transaction. And as far as account aggregators are concerned, I want to send the data today to you, but at some stage I want to pull it back. I don't want the data to be lying with SBI for a longer period of time. And once the purpose for which I'm sending the data is exhausted. How does one manage that? And there's 5 or 6 account aggregators or more. Who regulates them, and what is the assurance of security and confidentiality?
Look, one thing of this is in the ecosystem agreement, the use of that data is purpose limited. So if you share your bank statements, say for a loan application, the lender agrees not to use that to cross-sell insurance. And there is revocability. Say if you do have a loan, say for 3 months, they get access to streaming data, like at some interval, right? Like it could be every week or every month or what have you. But after the 3 months, that streaming stops and you can revoke consent. But you can't revoke it during the life of the product because that is used for monitoring the loan.
Got it. And what about security and regulating these account aggregators?
So they're regulated by the RBI. So the NBFC account aggregators are regulated by the RBI. The technical standards are issued by Debit. And Sahamati is like the ecosystem manager that manages all the participants in the ecosystem.
So again, the account aggregator, and I'll kind of move on after this to the next question or the next topic. The account aggregator is again an infrastructure that's available, but the availability of credit per se will still be a function of the risk appetite and the business of the bank or the lender.
Yeah, that's right. That's right. So just to give you a sense, we've already given 3,000 loans on Gem Sahay. The interest rate varies from 10.95% to 17%. And the reason why this is a big deal is that this is giving loans to people who previously didn't get loans or got them at 24, 36%. So it's already in its little form has created a change. So we are obviously trying to expect this to make it scale across.
You're on mute, Rushi.
Yeah, there we go.
Yeah. Okay. So again, the point I have is that more, will you, if you look at again banks, for example, will they lend on a price differential? Because if you remember, right at the bureau when we started, we had also talked about risk and reward and pricing it off credit scores, which now, as you see, is happening. Nowadays, you'll see a rate which says with a little asterisk that if your score is above a certain limit. And that's the differential pricing. But if you look at credit cards, for example, credit cards are still being priced at a uniform rate, whether your score is 800 or my score is 600. So how do you explain this finesse that is required in the system? And when do you expect banks, public sector banks, to get to that where pricing is objectively determined based upon credit risk perception and reality?
No, so you've asked many questions. Let me take that like one by one, right? Like, see, number one, risk-based pricing already exists. Like the same lender, even on the existing reference implementations, forget retail, that exists anyway. Like people with a slightly lower, credit score will get a higher interest rate and vice versa. This is already happening with borrowers on Gem Sahay, right? You will start like a large bank may not even be willing to give someone a loan, but NBFC will. So they'll start at 17%. Then when they have track record of repayment, the bank might be willing to give them a loan. So that differential already starts existing. And even within that, NBFCs are also, after you have track, willing to drop the rates, right? Because the perceived risk has dropped. Now, another thing, which maybe the credit bureaus won't like me saying, but look, this credit score based lending was done at a time that there was no other data that could be used. Can you hear me?
No, you're dragging a little.
You can hear me, right?
Kind of, yes. You dragged a little in the middle, but keep talking.
Okay, I'm gonna. Yeah. So look, even the same NBFC sometimes will give differential rates to a second-time borrower. So this already exists. It's just a question of creating track. Now, something that credit bureaus won't like me saying, but look, for many years, because there was only credit bureau data available in aggregate, everyone said if you had a credit score, then you were good. But if you didn't have a credit score, you were high risk, and you would actually get loans at rates of prime, subprime users because they were first-time borrowers. However, now if you have bank statement data, GST data, like more sets of data, what's preventing someone lending? Like you could have a credit score on steroids, which doesn't even include repayment behavior, right? It could just be GST data plus bank statement data, and you'll get your first loan. Because it's kind of crazy, right? Like you borrow, most people think I don't have a loan, I've never taken a loan, so I'll have a good credit score. In fact, they have no credit score, or they're given loans at people, with at rates of people with low credit scores. Now, going forward, I think that will change as this bank statement data will become available straight from the source. Now, the second thing, you're exactly right. This credit cards charging you anywhere between 36 and 52% when you would go get a personal loan at 12 or 13% absolutely makes no sense. And the other thing, see, in India, like in the West, credit cards are actually credit tools. People actually borrow off a credit card. In India, you'll just get a personal loan, right? Like whether it's a consumer durable loan, or why would you pay 40% if you know you can get a personal loan at 12, 13, 14%? So is good. So you're exactly right. I don't know when that moment will come, but at some moment, someone will realize that you don't have to charge 50%, and maybe they'll take a lot of market share when they drop rates.
So, do you see debit cards going out of fashion one day soon?
I mean, aren't they kind of already with UPI, right? Like,
That's
okay,
that's what I meant, yes.
Right, you get a debit card, yes, when you open your bank account, but like, and maybe not people of our vintage, but the younger generation doesn't even roam around with a wallet. You just probably have your phone.
That's
so,
right.
Just anecdotally, I remember I was in like at an army fair in Kunur, and they were not even accepting cash, and they didn't have credit card machines. Everyone was paying via UPI. So I think it's already, we're already at that stage where you don't really need to carry your wallet as long as you have your phone.
Yeah, makes sense, actually. So the other point is that, and I'm going to take this opportunity since given your experience, we had the P2P lending as a fashionable thing that came in some years ago. And then the RBI came out with NBFC status for P2P. Then you have the buy now, pay later, the BNPL model that is there. But I'm also beginning to see articles which say that the BNP model will not work because it is based on the commission from the seller. So what's your view on these two? Are they fashions for the season or are they flavors of the day?
No, so you said buy now, pay later, and what was the other one?
The P2P lending.
No, look, so P2P lending is just disintermediation, like of the bank, right? It's a platform where the bank, like the platform won't take actually money on its books, but just aggregate investments, which are deposits from, say, people like you and me, and then lend it to someone else who wants a loan. So I don't think that will go away because it's regulated and there are a few companies out there doing it. And I don't think BNPL will go away either. But what I do think people need to understand, I think BNPL is sometimes packaged as zero interest loans or just paying installments. That is not true. Someone bears the cost, and that person is never the merchant or the vendor or the lender. It is always the user. So the price, the cost of the interest is built into the pricing and the installment. So in fact, if you pay upfront, you're actually worse off. So I don't think it'll go away. Maybe I feel maybe some regulations will come where the RBI says that, everyone has to be clear about what taking a BNPL type product means, that it is a loan, there is interest. You can't call it 0% interest just because everything is built into the cost of the product. Yes, the merchant pays, I think it's 2% a month for a 3-month product, but it's not like the merchant takes that, right? They just charge more for the product that you're buying. So yeah, I mean, I think it's here to stay. It's a loan, but to say it's interest free is probably a misnomer.
Got it. Okay. Do you see technology enabling decision making also in a bigger way than just looking at a credit score and ticking off 800? Do you see efficiencies in terms of process and that kind of stuff? Or will we still have traditional ways of evaluating a customer's application, maybe for a housing loan or a personal loan?
No, I'll go on a limb. So look, housing loans are a little different because they're obviously like collateral documents, like you have the lien on the document and all that. So that, but see, underwriting for unsecured credit, there is no reason why a human should have, like, given the infrastructure that will soon be available, why a human should have to interact with it. Now, a lot of people also quite merrily throw around artificial intelligence and machine learning, and so look, machine learning and artificial intelligence basically means if you are streaming data, like live data coming in every second, and you are making changes to your credit policies and your models on the fly, that is actually AI ML. If you can't really call, I'll reset my credit policy every 1 month, AI or ML, right? Because it's not happening on the fly. So, I mean, the short answer is in 10 years, if you're not doing this, how is a lender going to compete with others? Or an insurer or a wealth manager? Because if you can't use this technology to deliver it cheaply, which the guys who do, they'll probably win and have access to larger markets than the guys who do everything manually, because their costs will be higher.
Got it. So I want to jump a little to the regulator. I think the regulator is grappling with many things, the fintech thing, the Chinese application thing, then of course the C word, the cryptocurrency, which we won't talk about, of course. So there is all kinds of things happening. The RBI recently came up with these instructions about not loading wallets with credit card amounts and credit lines and all that. So is the RBI, according to you, and without kind of putting you out on this thing, are they on top of all these developments that have been driven by technology and therefore are beyond brick and mortar, or do you think
No,
all out?
I don't think the RBI has done anything wrong, and might be in a very unpopular view in the tech and innovation circles type of thing. Now look, let's take the first one first, right? People call it Chinese apps. Look, they're not only Chinese apps, there were Indian apps as well doing the same thing. But one needs to understand, like, everyone's framing those guys as digital lenders, but they're not regulated entities. They would partner with an NBFC, and you could call it regulatory rent. Like, they would rent out an NBFC's regulatory infrastructure and then go and lend and collect and that sort of thing, right? And then give some share to the NBFC, where the NBFC owner had to do no work. Now, that was not the design of an NBFC. If you have an NBFC, you manage the business yourself, right? You can't rent it out to third parties who have not been screened by the RBI. So that is one thing. See, the second piece, like I noticed your framing of that recently the RBI issued guidelines for those prepaid instruments. These are not recent guidelines. So people knew they were operating in a gray area. If it worked out and the RBI let it happen, then you would be great. But because they just reminded everyone, said you can't do this, it obviously like dismantled a lot of people's business models who, like fintechs who raised a lot of money on that premise, where they created a synthetic credit card using a prepaid instrument and NBFC credit lines. Right now, if it was clearly not permitted previously, and then like how, I don't understand why people are pointing fingers at the RBI saying that what they've done is sudden. It was always there. It's just that people went ahead in the name of innovation, but you can't innovate. These backstops are put there for a reason, right? And which is why we've had a lot less problems than other countries. So yes, fully support innovation and new products, but I think it needs to be done in conjunction with the RBI, even if it's slow, as opposed to going out there and just synthetically creating products, which then it can end up quite badly for some users, right? If unregulated players are going and selling these products.
All right, that makes sense. What is the downside of all this? Is there a downside at all to all this? What can go wrong? What should the various stakeholders, be it a consumer, be it a lender, be it the regulator, what is it that can potentially go wrong? And the second part of that question is what should be done or what is required to ensure that you mitigate or minimize what can go wrong?
See, the major thing, like, look, we are making it so easy to get credit. Obviously, lenders will have to obviously create credit policies to enable that stream of credit. But the thing is, people should understand and be able to understand what they're getting into, right? So, many years back, like 5 or 6 years back, I remember I'd gone to Calcutta with one of the microfinance institutions and did a route walk to the borrowers, and they were physical, obviously, with microfinance. You meet the borrower, assess them, and then give loans. And they would keep saying, Lena hai to dena bhi hai, Lena hai to dena bhi hai, because they kept reminding the borrower that, okay, if you're getting a loan, you have to pay it back. Because otherwise you get a loan once and never again. And then it'll create all sorts of stress in the system. So I think education, even when you create tools, credit is a double-edged sword, as we often see in various situations, like, young people get a credit card, go wild, suddenly they're debt trapped, then they have to convert it into a personal loan, paid off over a number of years, get back on their feet. So those are still educated people. Imagine if this goes down to like a vegetable vendor and they don't fully understand what they're getting into. So I think we need to, as we're putting out standards, like what is the minimum product display criteria? What needs to be displayed to the user? How do you ensure that they have an understanding of what they're signing up for? That sort of thing is what we'll have to worry about as this scales.
Okay. Anything that the consumer should be careful about?
No, look, the problem with this is there'll always be new consumers who will make mistakes, who will have to, correct them. Some will be prudent right from the beginning. The idea is just to be very clear about what you're getting into, not to get taken away by the fact that, someone's giving me money, so I can go, have a good time with it and then like not be able to pay it back, because that has consequences in the long term. But I think that's the major concern. But that can be addressed by education. And this is not a problem which you are unfamiliar with. It was there 60 years ago. It'll still be there tomorrow, right?
Yep. Okay. So, the pandemic kind of, hopefully it was a once in a lifetime event, but the pandemic kind of threw up the risk factors that come with lending to the lower income and the informal sector because of the volatility of their volatility and stability of their jobs. A lot of people said we will take lesser risks in lending to these people and all. And on the other hand, you're creating rightly the infrastructure to enable people to lend. can you see a pandemic-like situation, which happens hopefully once in a lifetime, actually slowing down this whole process, which the infrastructure is trying to lubricate?
No. See, like, I mean, to base any of this on like a once in a century event
Yes.
probably is not the best thing, right? Like, it's, I think very rarely will we find that the whole world shuts down for 3 months, and creates the disruption that it created by those actions. I mean, if it happens again, sure, we'll need governments to help out. But like, I mean, that's a black swan event, right? What are you going to do? Like, you can't not go down that path assuming that will happen. It's like saying I won't drive a car because I might have a crash, right? Like,
Sure. The other point is, and since you talked about this happening once in a lifetime, hopefully, is that what doesn't happen in a lifetime sometimes is political patronage of people saying don't pay your loans back, especially the vote banks, which again can turn off lenders and banks.
yeah, but see, we assume the worst, and this is maybe a particularly credit risk problem, that you always assume the worst of people. Yes, that has happened in the farm. But, with these micro loans, I think like largely you've got to trust. Obviously, you do your due diligence and underwriting, but I mean, I don't think there's a comparable where you're like, there will be some people who don't pay, there will be some people who will default, but I think the majority will pay, right? Otherwise, credit would never be a thing wherever in the world.
Okay. So I have two questions kind of to bring this to some kind of a conclusion, and hopefully we'll get some people to put in some more questions directly to you. But obviously this is a pretty myriad, kind of, there are lots of things happening, a lot of things people don't understand and all. Whose mandate is it to kind of create an education to the consumer, to that lower end of the MSMEs or sector? And is that going to be a structured mandate, or is it that all the stakeholders will get up one day and say, you know what, yeah, we need to do this anyway? Because this whole education process, there's a lot of, fear about the unknown.
No, so I mean, maybe in the future, like, see, like how Amphi does a lot of education about mutual funds. Maybe when Credol becomes institutionalized, it'll fall to us to do that education at a wider scale about loans. I mean, it won't happen immediately, maybe after a few years. But it's also the private players, right? I mean, it can't be that I will give loans, but someone else needs to educate my customer. There'll have to be some interplay with the private players who are doing this for profit to educate. I mean, actually, now that you mention it, like when you're walking around, whether it's a tea stall, near your office at Nariman Point, or like a food vendor, whatever, you still see the Google Pay, Phone Pay, those little signs with the QR code where you can pay and saying UPI accepted here and that sort of thing. Like I remember telling some of the iSpirit volunteers one day, we'll want to see like credit acceptable here, right? Like you could, like just with your phone, get credit and buy, I don't know, a pack of sweets, or buy a vada pav, what have you, right? Maybe the people as quickly as you can send money on UPI.
Okay, so I'm going to do a little rapid fire this thing with you. I'm going to throw some names at you, and you need to tell me what you see from a crystal ball perspective, the situation of these particular names that I'm throwing at you, and not names, but generic names, in say the next 5 or 10 years. So let's start with banks. Where do you see the banks 10 years from now, from the lending perspective, obviously?
No, see, look, a lot of the banks are quite cognizant of the fact that they won't be able to compete if they don't disrupt themselves. So I won't take the name, but one of the CEOs of a very, very large private sector bank said, "Tell me how to disrupt myself." So they're cognizant that you need to adopt, you need to change, you need to disrupt yourself, and they're pushing their teams to do it. You will see. I think you'll see smaller brick and mortar banks, but larger, what you would call, not digital banks, but more use of technology to deliver services over time. It'll take time, but it'll happen. Like you won't have to go into your branch for many services. You'll be able to do everything from your phone, like you described earlier. and that's the whole idea. Like, even if you take simple things, right? Like, say a villager sitting somewhere in some remote village has to walk, I don't know, 5 kilometers to a bank branch. But if they have like a banking app on their phone, why can't they get credit or whatever else that they want just from the phone?
Yeah, I guess it's like I keep telling people, these are the test match. These are not T20 games you're playing. So it's going to be an evolution of the process. So let's go to the next one. Next name I'm going to throw, credit bureaus. Where do you see them?
I mean, they're necessary public infra. So they provide a service to be able to, repayment history, to be able to underwrite customers. I don't see that going anywhere. They've been around for 60 years. They will be around for the next 60. So maybe in a different form, maybe the reporting will get much faster. It'll probably move from like delayed reporting to real time, because we're able to give loans in real time. So then you'd have to report them in real time to be able to help banks underwrite adequately. But yeah, I don't think the business will stay more or less the same. It'll grow with the economy and grow with the lending. I do think there will be pressure on their pricing, because, for example, if I'm giving a 500 rupee loan for one day, we can't even charge $20, right? Because it won't be profitable for the lender to do it. So that will have to change over time. And I think the large volumes of lending will solve that problem.
Okay. The other thing I'm noticing increasingly is banks are becoming marketplaces to sell goods through their platforms. And therefore, platforms offering credit, like, the Amazons and all that of the world, are offering credit for people to buy. So do you see at some stage this becoming like a fuzzy, intermingled state of affairs?
Yeah, so let's take it two ways. Like, look, everyone's trying to become like a super app, right? But strangely, in India, people still seem to like specialty stores. So everyone is going to try, obviously, to try to capture the user and that sort of thing. But the other piece, right? And that ebb and flow will happen. There's for a few years, everyone tries to do super apps, and you realize that doesn't work and doesn't justify the investment to have multiple products. Then you pare them down and go back to doing specialty, and that ebb and flow will keep happening. But something that will change is what we call embedded credit, right? So today, if you're transacting, say I'm a restaurant owner and I'm transacting on Swiggy and I need credit, why should I have to go to my bank separately? Why can't I just get credit in that flow? So that I think will change. Like you said, if you're on Amazon, whether you're a retail or like a seller on Amazon, you shouldn't have to go anywhere else. The credit should be delivered to you right there, right? The flow. And that's what we're actually enabling. So think about, like, rather than having a specialty lending place, you will just like burst that out into thousands of places where lending will become a feature for all these other retailers and products, where they will be able to provide credit on demand. Obviously, if they're underwriting properly using all the data and all that. And that's what will happen, I think, going forward. I mean, we are working on use cases for agri-trade financing, for even financing a water buffalo, for financing, we are working with the India Post Payments Bank to try to create a use case for remote villages, because their postmen go anyway. So can they become like an assisted, like a banking correspondent almost, for people even who have feature phones and don't have smartphones. So there are lots of things going on. So obviously we'll do it one by one. We started with purchase order financing, then we'll do invoice financing, and we'll keep adding more use cases as we go forward.
So, obviously, while we're doing a lot of very interesting stuff, there are probably examples or use cases in other countries which have experimented, succeeded, or failed with an infrastructure of various components like what we are trying to introduce into India. Is there a learning curve for us there in terms of how to make sure it works better, mitigate risk, be careful? Is something succeed well? Is something fail? And are we on the right track in the context of thinking global but adapting locally?
No, but see, I'll tell you, okay, I'm going to be maybe a little politically incorrect now. But we, for many years, thought that the West will teach us what to do and solve our problems, right? But our problems are unique to us. And what you see in building out this infra is hasn't been seen anywhere else in the world, right? We are building things like, and in fact, we are becoming a case study for other places. And there's if you saw recently, there was an MOU signed with the French government and that sort of thing for UPI. So we are exporting the standards now, and so I think we need to get out of the mindset that we need to learn from others, and maybe now it's time that others learn from us.
Yeah, I don't think that was politically incorrect. In fact, it was politically probably the most correct thing that I've heard you ever say. So I think you're absolutely right. And I think, I think the rest of the world has a lot to learn. And this particular initiative, that this thing is there. So, kind of coming to the last part of my last question, I want to ask you and, throw it open to you. And I'd request all the participants, if they have any question, to put it down here. And we can get Rushi to answer. I don't see any questions. So either people have completely understood you or they've completely not understood you, one of the two. But I think, so if there are any questions, I request the participants to kind of put them in here so that we can get Rushi to answer. Rushi, any closing words from your side in terms of crystal ball 5, 10, 15 years from now?
No, I mean, I think, obviously we are trying to do our bit in terms of creating the infrastructure that will create wealth and help people build businesses on top of the infra. I think, it's a very optimistic time. We all hear about, India being the crucible of fintech, lots of interesting things going on. And along with that, there will also be some shocks. There will be some success stories. But I think if I were in my 20s, I don't think it's a better time to be in India than that. I wouldn't want to go to other countries to work because all the cool stuff is happening here. And I'll quote Michael Burry from The Big Short, right? People see, there are all these cool things happening. All you have to do is bother to look. All this information is there publicly. So if you want to participate in fintech, there are, all this information is available on the internet if you just Google it, and you can learn about it and figure out where to participate. iSpirit also does a lot of open houses, so you can look at that. You will find them on YouTube and watch. Finance is just one space. There's the health stack, which is the unified health ID and so on. There's drones and usage of the airspace for drones. So there's lots of stuff happening. You just have to bother to look and then try to participate and become, learn and be a little curious. But I think the next 10 years are a very, very exciting time to be in India.
Yeah, I completely agree with you. And I'd like to end with a little anecdote, which is true, is that apparently in the mid-19th century, which is like 200 years ago, the US government actually wrote to the US Patent Office saying it should be closed because everything that needs to be invented has been invented by now. And this is 200 years ago. So I think you're right that, the future, whether it's in Silicon Valley physically or in Bangalore in India, is with India and Indians. So thanks a lot for that. And we'd like to kind of just throw it open in case anybody has any questions, or we can end the session right away. We'll just give them a minute in case anyone is typing a question. Looks like you've done a great job. There's no question at all. So thank you. Thank you, everyone. Thank you, all the participants. And Rushi, thanks a lot for your time. And we'll be all eagerly watching
this. No worries. Thank you.
As potential stakeholders in this whole ecosystem that is being built. And I'm sure, we'll hear more about it and hear more about you as we go forward. Many thanks. Thank you, everybody.
Thank you for having me.